everyone. So, I welcome you all into the finance series which we have recently launched. So, this is the fundamentals of our masterclass on rules of investment. I welcome you all and let us move to the topic of today's, that is stock market fundamentals. We will be going through some of the major fundamental topics on stock market, and we also are going to launch a full course for 15 modules, and we will be soon calling webinars for the same. You can also enroll with us. We will be sharing our contact details at the end of the session, all the email ID and the contact numbers. So moving on, today's topic is stock market fundamentals. What are shares? What is investment? What are key points in investing? What is a company? Liabilities and rights of shareholders, public limited and private limited companies, and annual reports. So these are some of the basic terminologies which you might have heard while you are either starting to begin your journey in stock market or your financial wellness. So basically, I want to tell you all that financial wellness and well-being is very important aspect of human being, and it also defines our standard of living and how we are, growing, progressing in our lives. So it is very important aspect of our life, which is not mostly taught in junior school or high school. So it's very important for us to be updated on these terminologies. And it's not like there are certain myths which we need to avoid. Like people say that only a chartered accountant can get well versed in stock market, or a person needs to have a long history of mathematics. He should be either in commerce background. No, these are some of the myths which we need to demolish and move forward with the enthusiasm of learning finance. So I welcome you all to this course. So what are shares? Basically, before beginning into the topic of shares, there is a beginner's guide which we have. Even though investment conditions, attitudes, and opportunities often change over time and vary from place to place, the fundamentals, the principles of investment always remains the same. We say the rules of game always remains the same. It doesn't change even if you change the place, the city, either you move to tier 1, tier 2, but the basics, principles of fundamentals of investing always remains the same. So, are you one of those who wants to invest in shares and but doesn't know how well to go about it? So, we are here to help you. And as we discussed, even if you don't have any prior knowledge about stock market, you don't need to be an expert on economics, a chartered accountant, or only a mathematical wizard. People with a lot of common sense and a passion to learn and willingness to research on the companies and their business environment can earn fortunes in stock market. So this is some of the major myths which we're going to break, that a person need not to be a full versed with economics. He should have a basic understanding of understanding the balance sheet, the profit and loss, investors portfolio. So these are some of the common sense and some of the interest and attitude towards investment which we need to inculcate, willingness to learn and spend more and more time and effort in collecting and analyzing the information on companies and their business environment. So, what are shares? In normal language, shares are referred to equity shares or normal shares of a company. The terms shares and stocks essentially mean the same thing. An equity share is evidence to ownership in a company. So, when we talk about equity or shares, we are saying that when we have a company, say ABC or Hindalco, or any pharmaceutical company or any FMCG product. So we say that share are terms as a equity. It's a share equity of a company. It essentially means you're the shareholder or ownership. You have ownership in a company. The physical evidence of this ownership is earlier we used to have certificates, but nowadays it's more of electronic or dematerialized form of depository participant in the form of with the help of banks, brokers, and financial institutions. They're all under the guidelines of CB and National Securities of Depository Limited (NSDL). So basically, your ownership rights are proportionate to the number of shares you own. Supposing you purchase 100 shares in a company called XYZ Limited, which has issued 10,000 shares. So as you can calculate, what is the percentage of your share in that company? It's 1%. That is X% of 10,000 is equal to 100. So X is obviously it will become around 1, because you have got only 100 shares of those 10,000 shares which the company has distributed. So you are shareholding 1% of that ownership. In short, it would mean that if you own 1% of it, if you, from the above calculation, if we come to the conclusion, you are holding 1% of the company's land, factory, equipment, patents, bank balances, and all of its other assets. So when we say you're a shareholder of a company, that means you are owning all its assets, whether it's a land or equipment or patents or bank balances or all other assets. You're 1% part of that company. You are a shareholder. You own the shares of that company, meaning you own all the assets of that company, 1% of that assets of the company. Therefore, when you invest in the shares, you're actually purchasing a fractional ownership of the company. Now, moving on. According to you, what is investment? What do we say we need investment and why investment is so important? So if you go back in 1930s, it was not a very big thing. You know, the prices of the commodities and say the services and goods was not increasing drastically. It was not like we were, seeing a huge surge in the market price of goods and services. But beyond 1960, we saw that there was a lot of inflation. The prices of goods and services started to increase immensely. So there was a need. We were not seeing that the value of money kept on decreasing slowly and slowly. So investment basically refers to what you do with your savings in order to preserve them and make them grow or yield an income. If you keep your money in cash, they're certainly going to diminish in value. As we discussed, keeping money in liquid form will not increase its value, as we see with the inflation rate of 6 to 7% per year after 1960 to 2000. We have seen there is a constant inflation, constant surge in prices of goods and services. So that means the value of our money kept on decreasing. So in order to have investment other than cash, we need to invest our savings in some form of financial instrument to get the returns, which is more than the inflation value per year, which is 6 to 7% in value, because the purchasing power of money is constantly going down as a result of inflation. The value of money is judged by the quantity of goods and services you can buy with it. As we discussed, this is why investment is really, really important in these from 1960 to 2000 and from past 24 years. It's been extremely important. Investment is deploying your savings with the intention of preserving or increasing their value. This deployment can be done by using your savings to either buy land, commercial property, residential property, gold, jewelry, RDs, FDs. You all know about these financial assets, shares, bonds, or anything whose value will appreciate with time. So this is what is investment. You're basically taking your money, taking your savings, and investing in something which will in future return with you a certain amount of value, which will have appreciation in the original amount which you invested. It can be in the form of physical assets. It can be in the form of shares, which is or you can have saves in online format, dematerialized format, or you can either go for a land or residential property or commercial property, which will give you a huge amount of returns within a period of time for which you're investing. So the value of money is judged by the quantity of goods and services you can buy with it. Rental income also gets generated while you buy a house. So you must have, this is a very common phenomenon, like people buy houses and they give on rent so that they get a rental income out of that to generate revenue, constant revenue. They go for this. It will appreciate your value. Similarly, investment in banking options like bank deposits, shares will give you regular income. So these are some of the things which will definitely give you regular income apart from appreciation in value. Like real estate will always give you appreciation in value, but there's definitely it is not going to give you regular income monthly basis. Only if you go for a rental kind of a property, it will give you yield. And if you go for a shares or a RDs or FDs, it can also give you regular income, which generates over time. So there are certain, as we see, there are certain rules and there are certain basic points which we need to keep in mind while we go for investing. What are those? As an investor, you have to decide whether you only want to invest to appreciate in value, or you also need a regular income out of it, or you need a combination of both. So if you're an investor, supposing you're an investor, either you can go for investing if you want to appreciate your value for the investment, or you need a regular income out of it. So you need to decide whether you're going for the appreciation of value of your savings, or you only are looking for the a regular income, or it is a combination of both. So it is based on the investor how you're going to go with it. If the rate of inflation is 8%, after your tax investment must increase by at least 10 to 12%. So definitely every year we are seeing inflation, it's 8% inflation. So definitely you have to look out for certain financial instruments which at least give you 10 to 12% of return on investment so that you're able to bypass the inflation. If you want to improve your standard of living, this is why it has become important to learn the art of investing. Returns from investment in shares come in two forms: capital appreciation and dividends. What is capital appreciation? It takes place when there is increase in the price of a share. For example, if you buy 100 shares of XYZ company for rupees 1000 and later sell them for rupees 1800, there is appreciation of 800 rupees or 80%. So that is a profit which you make because initially you got 100 shares and the price of your shares was for 1000 and later you sell them for rupees 1800, then definitely there's appreciation on capital. It's 80% increase. And when you invest in shares, your capital grows quickly. Sometimes it can grow spectacular, going even as high as 1000% per annum. People get attracted to shares precisely because they offer exciting possibilities of getting rich. Now, who is a well-informed and a reasonably intelligent stock market investor? He who can, on an average, double his money in 4 to 5 years. It can be better than this based on how much experience you have and how much knowledge you have and the time and effort you're willing to invest on managing your investments. This is very important. One cannot be only speculating about the market that without, analyzing the business, analyzing the company's balance sheet and profit and loss. We cannot just speculate on the future outcomes of a share value. We have to become an investor. We have to thoroughly analyze the business of the company in which we are investing, and we need to have a thorough knowledge, like on what basis we are making those decisions. So it also has to be a little bit long term investment, and then only we term that a person as informed, well informed, and reasonable, intelligent stock market investor. You get income too in the form of dividends. Like if you're associated with the company and based on the profit of the company, which it made yearly, it will also provide you certain dividends. So investment in shares not only give you capital appreciation, it also give you income in the form of dividends. Dividend is the amount that the company distributes every year to its shareholders out of the profits it earns. As discussed, suppose there is a company X and it made a profit of 100 rupees. So maybe it is willing to share 6% of its profit, like 6 rupees to its shareholder, or maybe more depending on its profit. So it is known as dividend. Apart from the appreciation of capital, which is there in the share market, you also get paid in terms of dividends from the profit of the company. So we are coming to the most fundamental and the most important aspect when we invest. It's what is a company. Company is a form of a business organization. It is basically an association of individuals called shareholders. So when you buy a share of a company, you become a shareholder. Who get together for the purpose of running a particular business. A company is managed by a board of directors who basically make all the decisions. Their board of directors are consistently basically elected representatives of the shareholders. But certain board of directors are those who are having majority shareholder percentage in an organization, in a company. So those are people who are elected representative in the board of directors. The money that a company raises for starting and running its business is called capital. Capital is initially raised from the shareholders who jointly own the company. It is also called equity capital of the company. Companies also raise capital by borrowing from public banks and other financial institutions. So there are certain other terms which are going to look liabilities and rights of shareholders. So there are certain liabilities and rights of shareholders. Supposing you take shares from a company, so it's not like you are also eligible to pay liabilities of the company. No, company is its own entity, and you are just a shareholder. If supposing the company goes bankrupt, then you don't have to pay for other expenses or other liabilities of the company. You only get to lose the percentage of share which you had invested in the company, but you're not liable for any other legal aspect of the company. A company has an independent legal existence of its own, distinct from that of its shareholder. This means that a company can, without in any way involving its shareholders, enter into contracts, buy, sell, and own property, engage in litigation, incur debts. A shareholder cannot be held as personally responsible or liable for the actions of a company or any of its directors or employees. The liability of the shareholder to his company is limited to the value of the share he holds in the company. Suppose if you buy 100 shares of rupees 10 each, then your total amount of investment is rupees 1000. So suppose if the company goes down, then only you're going to lose 1000 rupees which you're invested in the company, but not other legal aspects of the company. Company has its own legal existence, and it's not going to be uh, dependent on its shareholders for the losses. So every time you must have seen there is something called private limited. So it's the limited liability on its shareholders. It's not, people are not going to face the legal consequences and the financial consequences of if the company goes to loss. It is only going to bear the loss of the percentage of the share which it holds in the company. That is very important. Initially, when a company is formed, shares in a company can be bought at their face value by making payments directly to the company. But we have seen, like supposing the face value of a company was rupees 10 in market price, but when it face value, but when it goes to stock market, when it get listed in the stock market, sometimes we've seen the share prices it's 1500 or 3000. So it doesn't mean that the company has made 3000 times the profit. It only means that the buyers of its shares consider that the company is very have a potential to be have a very bright future, and its shares are worth the high price they're paying for it. So it's all in the listing. These are all the, as we discussed in the with an example. The company does not get affected by subsequent transactions in which shares are bought and sold in stock exchange. When we say that the face value of a company share price is rupees 10, so when it becomes 3, for example, if rupees 10 of a share company is sold in the stock market at rupees 3000, each, it does not mean that the company is now 3,000 times richer. All it means is that buyers of its shares consider that the company has a bright future, number one, and its shares are worth the high price they're paying for it. It's not the actual price of a share of a company. It's the prediction, or it's the evaluation of its shares. The people consider that, buyer consider that the worth of that share is 3000 in the market price, and consider that all the company has a very bright future and shares are worth the high price they're paying for it. Now there are public limited and private limited. Definitely, as the name suggests, private limited companies are prohibited from selling their shares to the public, whereas shares of public limited companies are widely held by public and are freely available for sale and purchase of the stock exchange. There's something very important, and we tend to not go deep into it, but it's very important. Annual report. So every company prepares an annual report on its functioning and accounts and sends it to each of its shareholders. Annual report consists of directors report, auditors report, and fully audit balance sheet and a profit and loss account for the company. So it gets you to analyze how you're gonna invest and which share price value you want to invest in. So these are some of the basic um, things which we discussed as the fundamentals of stock market. So thank you all. Thank you for joining with us. We are also available on the mentioned email and phone number. You can contact us. We are also launching our full course module. It is a very interesting module. You will learn a lot of interesting things. So we have an experience of more than 5 years, and we have trained a number of individuals. So thank you all for joining. Do write to us at sales@cornerstoneadvinfo.com. You can also call us or WhatsApp us on 628 372 0458. Thank you all. Thank you for joining.